Good morning, options traders, and I've got a really good question for the group. Do market makers artificially alter prices? Well, if you ask most traders, they'll say, of course they do. Market makers will take prices down to scare people into selling. You hear that a lot, don't you? Oh, they're going to take prices down. And then they'll hike prices to encourage excitement and get people to buy. And so they're buying low and selling high and laughing all the way to the bank. And they'll say, well, the reason is obvious. They have an incentive to line their own pockets. Okay, that's fine. Hold on to that thought for a moment, and if you believe that their incentive is to line their own pockets, let's see if it follows that they have an incentive to deviate from the market prices. So to do that, we're going to have to dust off the economics books here and take a look at some charts. And we're going to look at volume on the horizontal and our market prices on the vertical. So the first thing is to look at what's called a supply line for the market maker. Can market makers generate supply into the markets? Sure, that's done by raising prices. Because when prices increase, it encourages sellers. Sellers like higher prices. So a market maker can encourage sellers by raising the price. So take a look here. If he starts at this price, he might get this volume. But if the price is raised up to here, it's going to generate this volume. So notice that higher prices lead to higher volumes, at least from the supply side, from the sellers. And of course, the reverse is true. If he reduces the prices, then he would reduce the supply coming into the market. All right, well, what about the demand side? That's done from the buyers. So for buyers, they are going to respond to lower prices. Buyers like lower prices. So if the market maker sets prices fairly high up here, yeah, he can still generate some volume. There's always going to be buyers or sellers at any price. The question is, what's optimal? So here's a particular volume, but if he lowers a price, let's say down to here, he gets a different volume. So if prices are lowered, the volume is increased from the buy side, from the demand side. So now all we need to do is to overlap supply and demand. And as you probably remember from basic economics, right here where X marks the spot is what we would call the market clearing price. And that just means that it's the point where the buyers equal the sellers. So the thing that's important about this is that this box right here represents the revenue. It's the price times the volume. So think about it. If you are selling, let's say, t-shirts on the beach for 10 bucks a piece, and you sell 100, price times the volume equals your revenue, 1,000. So the size of these boxes is going to be the revenue. So here's one price that the market maker could choose. He could pick a price where the number of buyers and sellers are equal, which again is theoretically what we should see. But again, this is where a lot of traders don't understand why that's theoretically what we should see. So they'll say, well, why would a market maker do that? He's going to just hike the prices up here. All right, could he do it? Sure. He'll still get some trades in there. He'll get some volume. What's the total revenue, though? It's the area of this blue box. What was the revenue for the old price down here? It was the red box. So notice that this area right here is common to both. So let's just look at the additional areas. The market maker would gain this much revenue because he's charging a higher price. So for whatever extra units he's selling, he is getting more money per unit. But there's a cost because look at what he's losing. He's losing volume. So the question is the red box bigger than the green? Or is the green bigger than the red? Yeah, see, the red box is a lot bigger, and that means he's losing more money than he's gaining. And that's going to be true for any price that's above the equilibrium price, where the supply equals the demand. So the market maker would have zero incentive to try to push prices above this market clearing price. Well, what about the other direction? Would he have the incentive to drop prices? Maybe he sees your sell order coming. He's going to artificially push prices down. Or maybe he's going to try to make a killing by really ramping up the volume. Well, what would happen? So let's say that this is the market clearing price, but he decides to try to cheat here and push prices lower. what's going to happen? Well, this is now the total revenue in blue, but based on the market clearing price, it was here in red. So this little area right here, this overlap, is common to both. So let's just take a look at the differences here. The market maker increases by this amount, but he loses by this amount. So again, the red box is bigger than the green, and that will be true for any prices that are below the clearing price. So the bottom line is that the market maker has no incentive at all to deviate from the point where buyers equal sellers. That is the point that's going to put the most money in his pocket. And again, this is called the equilibrium price or the market clearing price. So what's so special about this equilibrium price or the market clearing price? What it means is that everyone who wants to buy or sell at that price may do so. No buyers or sellers are left out of the market. This doesn't mean that everybody who wants to buy and sell can do so, but it means that everybody who wants to buy and sell at the market prices can do so. That's why it's called a market clearing price, because nobody's left out. So if you want to believe that the market maker's incentive is to maximize his revenue, that's a pretty good thought. You'd have every reason in the world to think that that's true. But then it must follow that the incentive is to balance the market. And there's no market maker in the world who could possibly know that you're about to send an order, or that anybody else is for that matter. The market maker just looks at the orders that are coming into the book and then balances them. It's up to the market to determine the prices. The market maker just balances that. So yes, the market maker has an incentive to maximize revenues, but that doesn't mean that he has an unfair advantage. Instead, it ensures that prices are fair for everyone. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.